my biggest concern right now is that this, to me, is we could be on the doorstep of another global sort of Asia contagion 2.0, right? That where the knock-on effects on risk weren't evident until 18 months after the initial wave of devaluations. So, anyways, I've said a lot. So
I know you've said a lot for sure. And to your point regarding the debt to GDP discussion with the dollar, if the dollar is a global reserve currency, why do we debt to GDP? Which GDP? The U.S. GDP, or is it a bigger part of GDP? Because if you're the 80, if you account for 80%, 87% of global transactions, if you're the dollar, then I guess the denominator should be something bigger than the U.S. GDP if we rank it in terms of debt to GDP. It's a bit.
that's a,
Uh, it,
that's
it's a
actually
bit
that's an
short.
interesting way to think about it. Yeah.
I'm saying that we're counting debt to GDP, and if it's debt to GDP, then why isn't Turkey the best performing currency in the world with 38% debt to GDP,
Well, but
or
it's also
Russia for
there's
that?
also but again, I mean, I think geopolitics matters
No, no,
matters a
no.
lot, right? Like
I agree
it's actually
100%.
everything. Yeah, yeah, exactly.
I agree. So when you're valuing a currency, and when you're valuing a currency which is the global reserve currency, there are more things to put into it. It's not only the debt to GDP and like taking a picture of a country, and
Well,
there is.
I also want to say that, like, who determines the fact that it's the global reserve currency, right? Because it's literally like, yes, you could say that there was this establishment of that order with the Bretton Woods Agreement way back, right? But if the dollar weren't the most liquid uh, currency market in the world, with the most liquid underlying bond market in the world, with all of these other factors that we just talked about, it would have been voted out organically by the market. You know what I mean?
I agree 100%. The liquidity and the ability to get in and out in the split of a second gives it this enormous power, and people feel comfortable owning it because they can sell it at the same speed. If you own, let's say, the Chinese renminbi, it's not the same case. It's the second
No.
biggest economy in the world, but can you get in and out? Do you feel comfortable holding your money in one, and where would you hold it, and how would you convert it, and how fast, and where would you hold it? You would hold it in Chinese bonds. All these things come into play, and then at some point, I'm saying this because the euro was supposed to replace the dollar at some point, and why hasn't the euro replaced, which is 19 democracies, which are Western, let's say, type of economies, not command and control type
For
of
sure.
economies. The euro was supposed, and the euro again has structural issues, which is 19 countries need to agree on something. So we've seen this discussion happening every now and then, I'd say every 10, 15 years, because the euro, when the euro came into power, it came into life. A lot of people were arguing that this would be the next global reserve currency, and yet yes, it got a big part of global transactions, but it never became the dominant one. So this is a discussion which is very interesting. And you mentioned China, which again, the currency should be lower from what you've said, and I tend to agree with that. But a lot of investors tend, you've been in discussions with a lot of people who say, yes, but China is now growing faster than the US. China has managed COVID better. We've had this discussion. China will outpass the US by XYZ. And yet the currency was pegged. Now it's managed, as you well put it. And we've seen it devaluing, steadily. Uh, a lot of people will think that this is done on purpose. I think, and I'd like your views on that. Is this done on purpose, or is it done because they can't do anything else? I think they can't do anything else. The world economy is slowing down. The local economy in China is so highly indebted that they can't do much about it. So now suddenly you see everyone from all over the world, including China at the amount they can, fleeing their currencies and going to the dollar. A, because it's a safer currency. B, because it has higher interest rates. C, because what you mentioned, it's you can sell it at any point. There's no if you change your mind tomorrow, you might as well not have it.
100%. 100%. I really disagree with this whole line of thinking that, oh, the Chinese are playing some sort of 3D chess, and the U.S. is just playing checkers all the time. I think that the whole, is just talk about like COVID policy for a second, right? The US for a while was the laughing stock of the world in terms of its COVID response, right? And Asia was lauded generally for its, uniquely authoritarian measures, right? But what's interesting is that, up until now, they still don't have an effective vaccine, and I think there's a lot of conspiracy theory with respect to whether the zero COVID policy has to do with like maintaining social order amidst like a property collapse, et cetera. I don't know, but I actually think that, what, maybe it's just that they're actually shitting bricks because they've got an aging demographic and they don't have an effective vaccine. Just take it for what it is. And you mentioned a couple other factors. I think one of the biggest factors right now is this notion of interest rate differentials. I think the key question that everybody needs to ask, and I don't have the answer to this, in terms of when the US dollar wrecking ball is going to stop wrecking, the key question is what other countries and geographies have economies that are strong enough to allow their central banks to outhawk the Fed. And from right now, I'm really not seeing many alternatives or many countries that can boast that claim. If you take the ECB, well, it's very well known the pressures facing the ECB right now in the Eurozone, given its energy dependencies, right? Japan. I posted I retweeted a chart from Charlie Bilello yesterday about just sort of a matrix of global bond yields, and Japan still one of the only places that still have like sort of negative bond yields, and their yield curve control policy has basically been a policy with no exit strategy, right? So I don't even know why the Bank of Japan bothered to intervene the other day, because if you're engaging in yield curve control while the Fed is on an aggressive hiking trajectory, why even bother intervening? You either have to either clamp down on capital controls, or you let your currency devalue, because what are they going to do? Let the JGB market go,
No,
right?
I think the intervention came in the sense that if a central bank comes out and says I'm going to intervene, you take out a big part of the speculation part, because if you're shorting it from a speculation point of view and you have the central bank against you, you might be forced to shut down your position, or you might get out, depending on how leveraged you are, depending on how scared you are. But you take a big part of the, let's say, the quick money, which could be short. Now, from a structural
Well, they
point of
were
view,
they
as
were
you
they were successful for 2 days.
no,
You
no,
know
no,
what I
no.
mean? So
I agree. I agree. But again, even if there are no more shorts, why would someone keep their money into Japanese yen? Why not take and deposit them in dollars for that reason? Even I'm saying take out the speculation part, but the actual part is you being a corporation in Japan and you can freely move your money, or being a person, being a saver. Why not take your money and take it and put it in US dollars?
no, I'm just saying that, like, unless they actually do something about their YCC, and actually let the JGB market go, which I feel like they just can't. Their back is against the wall. And in a currency intervention is kind of almost like a futile attempt to put your finger in the dike, so to speak. It's not going to do anything. It'll do something on a very short term basis, but it's not going to change the overall dynamic of where capital goes, right? So So and I see back to China and the renminbi. I mean, there it's a different story because because the currency is not freely convertible and they have basically capital controls in place. They can uh, keep the CNY still sort of artificially overvalued, so to speak. But I have to guess though that this has got to be a big topic of discussion in the PBOC. I think they're really on the back foot here because on the one hand, a devaluation is what they need in the face of devaluing currencies all around them in the region, the Korean won, the Taiwan dollar, Singapore dollar, all of Southeast Asia, right? Everybody is devaluing against the dollar. And the Chinese renminbi is still holding up relatively speaking because of that peg. The but So on the one hand, a devaluation I think actually helps their export driven economy, but at the same time, as you and I both know, they're heavily dependent on importing energy specifically, which is dollar denominated. So it's it's not so clear what they want to do.
No, it's not clear what they want to show they're not weak. That's for one sure, for sure. The question here is the following: you have a domestic economy which is highly leveraged in one, and to put numbers in perspective, the banking system, the assets are about, I don't know, 400, 500% of GDP, which is huge. I imagine
Yeah,
this
it's
being
massive,
real
massive.
estate, which is falling. So on
Yep.
that front, you have that. And then you have an economy which is being funded by its current account surplus. And now that the global economy is slowing down, this
Yep.
current account surplus is likely to shrink. Okay, we've
Yep.
seen some indication of it stalling. It hasn't shrunk yet, but it's stalling. Now, on the opposite side, on your import side, as you well mentioned, energy is becoming more and more expensive. Okay, now it's fallen a bit because prices have fallen due to the dollar. But in renminbi terms, if the currency falls, you get squeeze on the other side as well. So you have this issue, and at the same time, you have inflation pressures domestically, which inflation pressures are the one thing that can cause unrest. The rest is more about people in front of screens. When the food prices start going up, it's a bit of a problem for any country, not for China as well. Actually. It's for everyone. And we've seen this
Agreed.
also in Europe. And I'm saying Europe because it's an open economy. Meaning the energy prices and fertilizers prices have driven food prices up and the cost of energy. So now the central bank needs to raise rates to raise the level of the euro, actually, because that's what it's trying to do. Because by raising interest rates, you'll create a recession. And we've seen how an economy which it's open, how it works, and we've seen an economy where it's closed, i.e., China. It doesn't work for the moment. But the pressure, it feels like me, it's like a steam heater. I don't know
It's,
how you call them,
yeah, escape
which
escape valve.
there's no escape valve at this point. The steam is building up, and you don't know where the knock-on effect will be. Now, in '97, as you said about the Asian crisis, if you remember, the Japanese yen started falling first, and it put pressure on the rest of the other currencies, would then devalue. And if you look at the, let's say, FX reserves in China, but you do not compare it to the GDP, but you compare it to M2. And I'm saying M2 because if you're printing money within, but the money can't leave the economy, it's like a balloon where you put hot air, hot air, hot air, but the money can't leave because of
Mm,
capital control.
mm.
M2 to FX reserves about 8%, and in the Asian tigers uh, devalued or depegged when it breached the 25% mark. So we're already past that point. And
Wait, so
the
what,
question
what
here,
what was that ratio? What was that ratio that you said? The M2 to reserves?
M2 to FX reserves to M2 is around 8% in China.
Hey, okay, got it. I didn't know
And
that,
in
but that's a good
and,
metric. Yeah,
and I'll send you a chart also if you like. We can put it on for
yeah.
the viewers to see it. And if you look at the Asian tigers, when they depeg was around 25%. Which what does that metric tell you? It tells you that there's a lot of money in the country, and that money is more and more and more that needs to leave or wants to leave again, because you have capital controls, you cannot. But for the moment, we have an escape valve. The people who can go through Hong Kong and take it out. There's still that mechanism alive.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.